Welcome to the deep dive. Today, we're taking a closer look at Kroger, the grocery giant.
Right.
We've got some interesting analysis here from the Motley Fool, suggesting that maybe now is a pretty compelling time to consider their stock.
Yeah, especially given the current market conditions.
Exactly. So what's the source we're digging into?
Okay, so the article is called Four Reasons to Buy Kroger Stock Like There's No Tomorrow. It was published April 24th, 2025 on Fool.com.
Ah, the Motley Fool. Been around a while.
Yeah, since 93. Their whole goal is basically helping people get smarter about finance, happier, richer, through guidance and market analysis on their site.
Got it. So for you listening, our mission here is really to pull out the key arguments about Kroger's potential right now.
Try to make it clear, cut through the jargon, give you the highlights.
Okay, let's jump in then. Point number one from the Fool. Kroger is a leader in consumer staples.
Right. Which, makes intuitive sense. They run something like, nearly 2,800 stores?
Yeah, under names lots of people recognize, like King Soopers, Ralph's, Smith's.
Exactly. And the article points out, Walmart has more locations, maybe more total revenue. Kroger is what they call a pure play grocery stock.
Okay, what's the significance of that? Pure play.
Well, it basically means their business is overwhelmingly groceries. So they're arguably less affected if people cut back on, say, electronics or clothes.
Because people always need to eat.
Pretty much.
Yeah.
Food's a necessity. So during economic uncertainty, that focus on staples can be an advantage.
Right, more resilient. And the article mentions they had a strong finish to fiscal 2024.
They did. There was positive momentum. They highlighted a 2.4% year-over-year increase in identical sales, excluding fuel, in their last quarter. That ended February 1st.
Okay, identical sales excluding fuel. Break that down a bit.
Sure. It's basically comparing sales in stores open for at least a year, but stripping out the volatile gasoline sales.
So it gives a clearer picture of the core grocery business performance.
Exactly. And that 2.4% rise was important because it actually reversed a decline they'd seen before. So, signs of strength.
Interesting. What was driving that growth then?
Well, a few things according to the Fool. First, customers seem to be responding well to their private label brands.
Their own store brands.
Yeah. They added over 900 new items last year, probably hitting a good value point for shoppers.
Makes sense. What else?
Their digital strategy is also gaining traction. E-commerce delivery sales were up 18% in that fourth quarter.
18%? Wow.
Yeah, pretty significant. And on top of that, they mentioned a company-wide cost savings push that's helping their margins.
So better sales, growing online presence, and saving money. Sounds like a good combination.
Definitely. And their own forecast for 2025 seems to reflect that confidence.
Oh, yeah. What are they projecting?
They're guiding for 2% to 3% identical sales growth for the year.
Okay.
And earnings per share, or EPS, between $4 and $4.80.
Which is up from 2024.
Yeah, about a 3% increase at the midpoint compared to 2024. So, continued steady growth expected.
Okay, interesting first point. Now, the second reason the Fool brings up, this one I found kind of surprising.
Let me guess, the advertising and data business?
Exactly. It's not the first thing you think about with a supermarket, is it?
No, not usually. But it's becoming a really vital part of their profit picture, apparently.
How does that even work for a grocery store?
Well, think about it. They have over 11 million customers coming through daily, plus a huge loyalty program.
Right. Everyone has that Kroger card or app.
Exactly. So they have tons of data on what people buy, when, where, and they leverage that proprietary data.
To sell ads.
Yeah, basically. They deliver targeted ads, digital ads, stuff you see in the store, even on connected TVs now. It's called Kroger Precision Marketing, or KPM.
And is this like a side hustle, or is it actually significant?
Oh, it's significant. Get this. In 2024, KPM's media sales surged 17%.
Okay.
And generated $1.4 billion in operating profit.
$1.4 billion, just from that.
Yep. Which, the article points out, was over 25% a quarter of the company's total operating profit.
Wow. Okay, that's way bigger than I would have guessed.
Right. And it's described as a high-margin, tech-driven kind of business. They're even using AI now to refine the insights and targeting.
So it diversifies them beyond just selling groceries, and it's very profitable.
Precisely. It strengthens their long-term earnings potential in a way that maybe isn't fully appreciated yet.
Fascinating stuff. Okay, let's move to reason number 3, dividends.
Ah, yes, the dividend growth outlook.
Yeah.
Always appealing to certain investors.
For sure. Regular income. What's the story there with Kroger?
Well, they've shown a pretty strong commitment. The article notes they actually doubled their quarterly dividend over just the past 5 years.
Doubled it, okay.
Yeah, it's now at $0.32 per share each quarter, which gives it a dividend yield of around 1.9% currently.
And are they expected to keep raising it?
Management has indicated, that further dividend growth is likely. They seem committed to returning cash to shareholders.
And it's not just dividends, right? The article mentions something else, share buybacks.
Correct. They have an ongoing share repurchase authorization. The idea is, between dividends and buybacks, they're targeting an annual cash payout yield to shareholders of around 5% to 6%.
And buying back shares can help boost the stock price over time, potentially.
Yeah, it reduces the number of shares outstanding, so each remaining share represents a slightly larger piece of the company. It can provide a nice tailwind.
Okay, good to know. That brings us to the fourth and final reason, Kroger's valuation.
Right. The argument here is that the stock looks attractively priced.
Especially compared to, well, a lot of the market right now.
Exactly. Despite all these strengths we've talked about, the staple business, the growing ad revenue, the dividends, the stock's valuation seems, well, reasonable.
How are they measuring that?
Primarily using the forward price-to-earnings ratio, or PE. Based on the consensus analyst forecast for 2025 earnings, Kroger's trading at a forward PE of about 15.
15. And how does that stack up?
Well, the article contrasts it pretty sharply with the broader market, which is higher, and particularly with peers like Walmart.
Which is trading at?
A forward PE around 35.
Mm-hmm.
And then you look at Costco.
Even higher, I bet.
Yeah, closer to 55, according to the piece.
Whoa, so 15 versus 35 or 55, that's a big gap.
It really is. And so the argument from the Fool is that Kroger, maybe, deserves a wider earnings premium, a higher PE ratio than it currently has.
Because of things like that high-margin media business we discussed. And the digital growth.
Exactly. Those factors, plus the improving profitability overall. The thinking is maybe the market hasn't fully priced those elements in yet.
Could there be skepticism, though, like about how sustainable that ad growth is, or maybe the competition in online groceries?
Oh, absolutely.
Yeah.
That's always part of the calculation. But the expectation laid out here is that if Kroger keeps putting up strong results, keeps showing that resilience, then that could lead to continued positive stock performance as the market, potentially reevaluates its worth.
Right. The valuation catches up to the performance.
That seems to be the thesis.
Okay. So let's try and wrap this up. The Motley Fool's case for Kroger boils down to these four things.
Yeah, first, its solid position as a consumer staples leader, focused on necessities, resilient.
Right. Second, this surprisingly large and growing high-margin advertising and data business, KPM.
Mm-hmm. Third, a strong track record and outlook for dividend growth, plus share buybacks returning cash to shareholders.
And fourth, what looks like a pretty attractive valuation, especially when you compare it to its peers and the wider market.
That sums it up nicely. You've got the steady base, the innovation on top, shareholder returns, and potentially a good entry price.
It's definitely a compelling picture they paint. This has been really insightful digging into Kroger like this.
Yeah, lots to consider there.
It really makes you think, though, considering Kroger's focus on just selling groceries, but now making so much from data and ads. Yeah. How are these traditional business models going to keep evolving?
That's a great question.
Like, what other non-traditional revenue streams could become really significant for these kinds of companies down the road? Definitely something for you, the listener, to mull over.
Food for thought, you might say.
Indeed. Thanks for joining us for this deep dive.